and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about what happens when a developer goes under. This actually comes from a recent story, which is very unfortunate. Big development of 700 properties in Auckland, in South Auckland, called Ormiston Rise. Now, if that sounds familiar, it might not just be because you read about it on Stuff, but we talked about this back in episode 502 of the Property Academy podcast as one of the big KiwiBuild developments where properties were being sold quite a lot under value.
Oh, this is the one. These are the developer.
This is the one that was being sold for $650.
We told you that you might got a lotto ticket. Now someone's actually just gone and ripped up that lotto ticket.
Well, not necessarily. So these properties were being sold some at market value, but some for $650K, and these were being allocated to KiwiBuild purchasers through the lottery or the ballot system when they were being sold on the open market for quite a lot higher, about $789K. Now, very unfortunately, all of those purchasers got an email or a letter on Friday at 5:30 p.m. saying, your builder is in receivership.
Which is not very fun on a Friday afternoon because you can't even ring your lawyer and talk it through.
And I suppose for me, that is the biggest issue, which I'm seeing purchasers say, that they don't know what this means because it hasn't been worked through yet. So they've been notified the fact that their builder's in receivership, their builder is potentially going under, but they don't know what rights they have yet. They don't know what's going to happen. Now, by the time this podcast is released, maybe some more details might come out, but I think it is important to say, well, what happens when a developer does go under if you're purchasing a new build, especially because we expect these are going to become much more popular now that the full LVRs are on, the interest deductibility, and some of those other government legislation which are making new builds much more attractive.
As a developer's going into receivership, I do expect that you're going to see a lot more of that. And in the 8 years that we've been running Opus, we've never been dealing with a developer that then has gone into receivership, but it is just something that is a risk with buying off plans.
Well, let me pick you up on that. Why is it that you're expecting more developers potentially may go under?
Well, see, I think the interesting thing is right now you've had kind of the perfect storm. There has been a pretty good run for developers. Take, for example, Christchurch, right? The land was very cheap post-earthquake in the city, and it all got snapped up at very, very competitive prices. And then, of course, there's been a lot of demand. Then you look at somewhere like Auckland, where the market has been going really well over the last couple of years. Prices have been increasing. Now we're seeing a bit more of a stable market. Just in the, how many weeks has it been since the government's announcement?
It's been about 5.
It's been about 5 weeks. There has been a noticeable change in the market. Now, that's not to say that the market's come to a screaming halt, but it's definitely a change in the air. And the way you know that's happening is when developers are calling you, talking about projects all of a sudden. So they're not relying on their own marketing, and they're not relying on their own clients to come in and buy properties. They're actually having to be a bit more proactive again. So that signals to me that maybe sales are being a bit slower for developers. Couple that with the fact that the biggest thing that hurts a developer is time delays, and with supply chains being slowed down and the cost of a lot of the stuff that you buy, timber, for example, going up, that's going to really hurt some developers, and a lot of them may not have seen these harder times, and cash flow will become an issue.
Yeah, there are certainly 2 factors that could potentially lead to more developers going into receivership. The first is that bullish market making them feel very confident in their own abilities, which means they potentially take on more risk than they may otherwise. So they may have taken on more risk. If the market then slows down, that could then put them in a pretty tough position. The other thing is the inflation on the cost of building materials. So it's been pretty well publicised, this shortage of timber and inflation in the price of timber, which then squeezes developer margins. I was talking to one developer over the weekend who said that usually they will factor in an 8% inflation rate on their building materials, and they're currently seeing that the price of everything has gone up about 15%. Now, some things will have gone up 0% and some will have increased much more than that. But certainly my understanding is appliances, for instance, are pretty hard to come by, and the price of them is going up quite significantly, and that's squeezing builder margins.
Yeah, and if you get to the end of a development and you've just got to get the appliances in, but you can't buy any, then probably people aren't going to settle because they're buying a complete package, and so that's where it becomes a real challenge. You know, you have an extra couple of months on a build just because the ovens can't be supplied. That's 2 more months worth of interest that you've got to pay for your holding costs.
Well, let me ask you this, Andrew. How worried should an investor be about a developer going under?
It depends, I guess. If you're working with someone like us, then obviously there's a certain level of scrutiny that goes into a developer before we take them on board. If you're going direct, then I always recommend you do a bit of research and have a look at who the directors of the companies are. Check what their history is like. I had a friend of mine actually contacted me at the weekend, talking about a developer that is finding it hard to get money, and that's actually another big challenge at the moment. And he said, this guy's got an amazing return. It's going to make me rich. And so I said, let's catch up and talk about this amazing return. It was like 30%. And my rule of thumb is if it's too good to be true, it's not true. As soon as he told me the guy's name behind it, I told him, don't touch that with a barge pole. That guy is... he's notorious for spending other people's money, and he's got no substance himself. So this is a guy who's very charming and had gone out there and posed as a developer. None of his own money, was getting other people to write checks. Now, I don't know whether or not it's true, but he reckons that 2 very serious guys in New Zealand are lending him money. One of them's a friend of mine, so I plan on ringing him today and finding out if that's true. If it is, I'll put a stop to it. But there is a lot of polished developers out there that can sell the sizzle, but you got to make sure they've got a bit of substance. All of that aside, if you're buying for an owner-occupier property, this is probably a real pain for you because you've got to go and find another home. If you've gone through that ballot system and it's taken you 2 years to get there, and now all of a sudden you're going to get your deposit back potentially, but the market's gone up $100,000, that's probably a real challenge for you. As an investor, this is a real pain in the butt, but it's not a life changer so long as your deposit's protected. So that's one of the key criteria for us. We want to make sure that a developer is not going to get use of your money, because if they do and they go into receivership, an incomplete house is never worth anything like what you've put into it.
Yeah, so definitely keeping that, making sure that those funds, the deposit you're paying, is being held in a solicitor's trust account. So certainly as an investor, yes, it will be annoying, but there's only really 2 things you've lost if your developer goes under. First of all, if you've borrowed your 10% deposit, which you've then paid into that solicitor's trust account, then you will have been paid interest on that. Now, interest costs are so low that it might be a couple of grand, like $1,500 that you might have paid as interest on that in order to be able to borrow that deposit and pay it. Now, of course, you will get that deposit back with some interest. So you might have lost $1,000, say, on that. Now, that's annoying, but it's probably not going to change your life. The other thing that's a bit annoying, and this is more of it, is the potential capital growth that you've lost. So let's say that it was a 12-month build. Well, especially if you bought back in March. So let's say you bought it in March 2020, you signed up for a property, 12 months later, you're in March 2021, house prices have gone up 20%, but you're still paying last year's price. So over that period, that construction period, you've made 20% in effect because you were going to pay the same price that you'd signed up for back in 2020. You're going to get a house that is worth what it is now in 2021, 20% more. But of course, if the developer goes under and that project is then not completed and you get your deposit back, well, that's great that you got your deposit back, but of course you've missed out on that capital gain. Now, look, I certainly don't think that we're going to have as frothy capital growth over the next 12 months. We're not expecting to see another 20% worth of capital growth, but even if it was 2% or 3%, you'd still be pretty gutted that you missed out on what could be $15,000, $20,000, $25,000 worth of equity that you'd made over that period. But really, you haven't lost something. Wouldn't be the end of the world, but certainly would throw a spanner on the works. So it's still worthwhile doing that kind of due diligence on developers.
Now, just one thing, and actually, Joe, if you're listening to this, Joe, who's one of my good investors, I was talking to him, I think last week, about master build guarantees and in a project like we were looking at, the fact that they're a little bit redundant. They're a well marketed product, but they're a little bit unnecessary. In a situation like this, they can be beneficial because if you're a master builder, then generally speaking, you'll find that another builder steps in and completes it for the same price. And we saw this with Stonewood must have been 10 years ago. So Stonewood went into receivership. And they eventually got bought out by the infamous Chow brothers. I had a friend of mine who was building an investment property through them at the time. Now, that was a progressive payment build, so they already owned the land and then they owned half a house. So the master builder that took it over completed to a good standard, and she was very happy. But I think it was about a 4-month delay or a 6-month delay, so there was extra interest cost there.
Very unfortunate. Now, first of all, I just want to mention as well, you can do as much DD as you like, but sometimes a project will go under and there may have been no way to know that was going to be the case.
Absolutely.
So if you look at the board of directors of this specific project, when I had a quick look, 2 of them were in Australia. It appeared to be a relatively well-capitalised company. I don't think there was much to give away that this project would have gone under if you were taking what I expect most people would, which is a pretty casual look. So you certainly can't always tell that this is the case. Now, I just want to talk about the difference between going into receivership and going into liquidation, because these are 2 different things. So when you go into liquidation, basically the whole company gets sold up and all of the creditors get paid out depending on what priority they were and the sort of agreements they had in place. Receivership's a bit different. So rather than being appointed by all of the creditors and working on behalf of everybody who's owned money, when you go into receivership, one secured creditor who's owed money can then put in place a receiver, but they will only control the asset that was put up to security. So usually this might be a bank who has security over a piece of land, who is then able to say, look, we're unhappy with the progress of this construction, which is exactly what happened in this case. We are going to appoint a receiver to try and either trade the company or sell the piece of land or get somebody to take over this project so we're able to get our money back. That's what's happened in this case. Now, the key difference there is that when you're in receivership, you can still trade out in some instances, keep the company trading, keep the company moving forward, but just getting it into the position where that secured creditor is happy with that progress.
I have actually seen other situations where building companies might go into receivership midway through a build that a developer has put together. So, for example, the Dixon Apartments in Wellington, I can't remember who it was that they were having doing the actual build work, but they went to receivership in the last sort of 20% of the project, and so they were the developer, I guess, who had put the whole thing together, managed to switch them out, but again, there were delays.
Oh, is that right? I didn't realise that the builder went under in that specific project.
Yes.
Because that's why it took so long for them to be built.
Oh, there was all sorts of delays.
Now, that's quite interesting, just mentioning the apartment where the builder went under, because just speaking about inflation in terms of building costs, I know in all of Bob Jones's books, he says, I would never be caught dead developing an apartment building or a high-rise office building, because you're looking at least a 2-year build period. There's more engineering required, there's more building materials, it takes longer, and so it becomes even harder in order to forecast what those building materials are going to cost and what the cost of labour is going to be and what the labour market is going to be like 2-3 years down the track. So certainly we may see apartment developers and office developers wear it harder than somebody building townhouses, for instance, which are it's much quicker to put these up and get them out, and so it's easier to understand or forecast what that inflation in building materials and building costs are going to be.
Absolutely. That's probably why you see this most commonly happening to major apartment complexes. One guy who was very successful at actually making this work was the Sugar Tree Apartments in Auckland. I actually spoke to him today, and it's quite funny because he rang me up and said, I've heard of you, and I said, yeah, I've heard of you as well. And I said, let me just get this right. This was your first project as a developer. 700 apartments in CBD Auckland, like pretty ballsy for the first development, but they did it in 3 stages.
Yes.
So the first stage they're really cheap. Middle stage, somewhere in between, and the last stage was probably his profit. And so by staging that out by 3 towers, he probably kept that running at a reasonable time frame. Whereas if you did them all as one stage or one project, like one building would be, that would be a real risk.
It was probably quite clever actually doing the first stage relatively cheap then, because everybody in Auckland knew about them.
That's
because
right.
they were advertised to be so cheap. Then by the time you got to the third stage, you still had that brand recognition,
That's
but
right.
they were more expensive. Anyway, we digress. But I think the key point here is to be aware of the risks, but don't let it stop you. If new builds are the right thing for you, then the fear that a developer could go under, you should certainly think about it and consider it. But it actually isn't going to be life-changing if that did happen. You want to avoid it, but again, it's not going to. It's not going to have the same effect as if somebody was building their own property as an owner-occupier and paying the builder over time under a progressive payments model versus a turnkey model. Hey, look, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, what I do want to mention is we're about to close off that draw. We are about to draw out the people who are going to come out
week
for dinner with us. Next week, we're going to do the draw. This is where we're coming to Auckland, Christchurch, Queenstown, and Wellington to have dinner with 10 of you plus partners to talk property investment. Oh, and I've got some wee doozies planned. I'm excited for it.
What have you been doing? Taking photos of me in compromising positions or something?
I can't possibly comment.
I have dirt on you.
Now, you've thrown me there, Andrew. Now, if you want to enter that draw, here's what you got to do. Rate, review, subscribe to the podcast. And hey, I realise that people listening on Spotify, there's not a function to do that. So that's okay. We'll forgive you. But if you're listening on
iPhone,
if you're listening on Apple, Google, or Podbean, definitely appreciate that. Share something about us on your story or on your wall, and follow us on Instagram. We are at @opus_partners, but we're going to be drawing that next week. Oh, and then send it, of course, to podcast@opuspartners.co.nz.
with your location.
Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.